This panel is completely stacked. So, and yeah, mixing the VCs together, you know, it's like oil and oil. So, why not? We have here collectively founded, I think, 7 venture funds. Probably, I counted between 5 and 10 billion of cap gains for our investors. And so I'm going to do really quick bios here before we get into the questions, but it is kind of an overloaded situation. So I'll say 1 or 2 things about each of you, and then introduce yourself real quick. Okay. Good. All right. So we have a co-founder of Underscore VC right here, Richard Dulude, who is like a fellow coder like me. I started my career writing machine learning code. You did it much later with much more powerful tools. So I feel like we're kindred spirits, separated by quite a few years. Prior to founding Underscore, you were at Founders Fund, is that right?
Founder Collective.
Founder Collective, got it. Veteran of many deals, very hands-on, very helpful for the companies. Tell us 1 or 2 things about yourself.
Sure. Good morning, everybody. I would say a few things. Underscore Boston-based venture fund, love to invest at the earliest stages. I would say a long time ago, I was actually an open source entrepreneur. That got me into Bitcoin and the like very, very early. Mining, just kind of playing around with the technology. We had some very early successful investments, led the seed round into companies like Chainlink back in 2016. And since then, that just kind of got us into the space, and we continue to invest predominantly in infrastructure. And now I spend 100% of my time in this space because I think to be successful in it, you have to.
So next up, Kavita Gupta. I mean, you look at this list of things that you've done. We were talking last night, your seed in OpenSea. Well, let me start by saying that she is previously was at Consensus Ventures and is now the co-founder or founder, I guess sole founder of Delta Blockchain. That's pretty awesome. So the list here has OpenSea, it has BlockFi, SoRare, Starkware, QuantStamp. I mean, these are like who's who of the industry. And I mean, we were talking last night, I think we could probably talk for hours, so we're going to be really focused with our questions. But tell us 1 or 2 things.
I think you did a really good job, Dave. Thank you so much for having us, first of all. It's a great event. I started in the space in 2013 and got really lucky, started Consensus Ventures at the very beginning of the space. Lucky to be one of the first investors in Polygon, Starkware, couple of other really, really great companies. And now we have Delta Blockchain Fund, a pre-seed, seed stage fund, investing globally. Really looking for a lot of infrastructure, interoperable analytics, and anything which can actually move the Web3 revolution into more interoperability and multi-chain. And very excited if anybody's here want to talk.
All right, so next up we have Andrew Durgee. Did I pronounce that right? And Andrew has been very helpful with us at XPRIZE, actually, where I'm on the board. We're designing NFTs for these world-changing causes. And in that room, there are a couple people who know what they're talking about. And it's funny, because they go back and forth at light speed. Everybody else in the room is just left behind. So you're one of those guys. And his bio is hilariously short, because it only needs 1 really big nugget, which is I've been doing Bitcoin since 2010. And I looked that up. It's like, come on. Did it exist in 2010? Bitcoin was born in 2010, and in 2010...
Earlier. I was late to the party.
Yeah. 09?
Yeah.
Well, 2010, you could buy 25 Bitcoin for $1. So I know a few other people, mostly MIT people, that are in that bucket. All of them are intensely private and very hard to get on stage. So we're incredibly lucky to have someone who's willing to talk and be on stage. So 1 or 2 words?
Yeah, super happy to be here. Love XPRIZE, by the way. Yeah, I've been in the space a long time. I mined my first block February 8th, 2010. That was where the journey kind of started. I was CEO and co-founder of the CoinTree, the first doing multi-sig security and storage for Bitcoin back in 2011, 2012, and 2013. And most of the modern multi-sig you see now has been built on that. I was a partner at TLDR Capital. We were the #1 ICO advisory firm globally, 2016, 17, and 18. Worked with every major player back then. And joined Republic in early 2019 to build out Republic Crypto. Been advisor or partner or investor to most of the L1s, your Algorand, Avalanche, Polygon, Solana, Polkadot, any of the heavy initial technical stuff. That's where we generally like to sit. But we've spread out much more from that now.
Yeah, and I'll point out that if you look on LinkedIn or you look anywhere on the internet and try and get that little soundbite, it's invisible. You'll never find that. So how many people are you going to meet that were advisors to pretty much all of the L1s? Ridiculous. All right, and last but not least, Kevin Farrelly on the monitor here out in California. Kevin was a founder. He's at Franklin Templeton now, leading their, Franklin Templeton is one of the mega asset managers with over $1 trillion of assets to deploy. And he's leading their cryptocurrency efforts. But prior to that, he was the founder of Random Forest Capital, which used machine learning and AI. So there's definitely a theme there in the capital markets, basically using AI to predict debt and credit and so forth. So tell us a word or two about yourself.
Yeah, thanks for having me by Zoom. So in 2018, I decided to sell that AI company to Franklin Templeton. So I've been at Franklin Templeton for about 4 years and 4 months. Going on 4 years and 5 months, I guess, in July 1st. At around the 3-year mark, I decided that there was enough data in the crypto and blockchain world to kind of replay what I had built for credit using machine learning and AI for venture investing and crypto investing for Franklin Templeton. So I approached Jenny Johnson, my CEO, and pitched her on a fund. We launched Franklin Templeton Blockchain Fund 1 about a year ago, this August, and it's been going well. It's been a team of data scientists. We like to keep it 60 to 40%, 60 technical, 40 business on a ratio basis. And the only PPM at the firm that can buy equity tokens, token warrants, and then a myriad of different custody solutions that I use.
Last but not least, myself. So I'm the founder of Link Ventures, co-founder of Vestigo Ventures. We manage about $1 billion here in town, very close to MIT. And I have a background in machine learning and AI and have been the co-founder of 23 companies, actually, before becoming a venture investor. So we have 20 minutes to answer all the world's questions, so we'll do our best. And I'm going to start with one that's really a loaded question. There's no good answer to it. But I get a whole line of texts from my family members all over the country saying, should I buy Avalanche or not? If there's an actionable thing you could do tonight in crypto, it would be buy something, Chainlink, Avalanche, or otherwise. But since we have Avalab's president here today, and we've heard a lot about it, should people be buying these tokens tonight or not?
I mean, I think we first need to say that we're not investment advisors, and this is not investment advice. And that goes across the whole panel here.
I don't know where SEC is, but we each have to start with that. It's like Bible.
So we're not going to get an answer, I take it.
I'll give a cop-out answer, but if you're long in the space, price shouldn't matter right now. That's the reality of it. If you're a day trader and you're going to play around and try to win the short game, that's a different story. But if you have long-term conviction in the space and you're going to sit in it for a while, 5 years or plus, the price should be relatively irrelevant.
All right, well, I'm glad you're at least willing to give an answer, a somewhat answer. Related question, so Kathy Woods was out at A360, the XPRIZE Abundance 360 conference, and she said the network model predicts that Bitcoin will go to about $200,000, $250,000 in the next year or two, and then will ultimately go between $1 and $10 million just based on the network effect model. So 2 questions in there. 1, believe it, don't believe it. And question 2, which is easier to answer, is, okay, you're a venture investor. We all buy equities and token warrants now. How do you think about valuing token warrants or tokens when you're investing?
I'll start with that. So a couple things. First on the Bitcoin question, I would say you have to think of it as the most inherently beautiful property of it is finite supply, right? So we know that's a predictable curve. We know how it's going into the world. What you don't necessarily know is what's the numerator, what's the amount of demand for that thing. And I think historically, over the back half of the last year, what drove a lot of the price increases was institutional demand for the first time. I mean, companies like Franklin Templeton and the like starting to move money into this space at a scale that was just so far in excess of any retail. And now you see it sort of ebbing out. And what drove that, in my mind, was actually this thesis that an efficient frontier portfolio model that adding an uncorrelated high returning asset would probably be good even in a small allocation in a portfolio. And so with trillions and trillions of dollars out there, even the little femto bit of a portfolio might actually be interesting to have this in a, and so the basis of that thesis was that this is an uncorrelated asset and inflation resistant. I think the inflation resistance is an interesting piece of it, but now I think a lot of that thesis has kind of crumbled under its own weight, and so that has driven a lot of capital out of the system. And if you're a big money portfolio manager, you're a sovereign wealth fund or others, I think you might have a long-stated interest to, yes, we should be participating in this space, maybe in the same ratio of gold or whatever. But I just don't think that you're going to see that level of demand that we saw coming back into the space for years. I think we're going to be in a sideways market for quite some time.
Oh, interesting. Can I ask you to get kind of a little personal and down and dirty on that question? Same with Kavita. So, we had kind of parallel but separated by years lives where you're doing machine learning and AI and then you're investing in equities. And, a lot of seed stage investing. And I'm sure most of your wealth you've made over your life is in seed stage investing. Then you wake up one day and you say, I'm going to buy a lot of Chainlink tokens. And that's, of course, life-changing. But, what are you thinking on that day? I mean, this is just so ethereal and so vague and so different from anything you've done before. What was it like?
Yeah, so it was, sorry, just to chime in quickly. That was a interesting one in that it was one of the first, I would call it, token deals we've done. In fact, we invested in a company which is a for-profit entity around the Chainlink protocol. In fact, the developers of the Chainlink protocol called smartcontract.com. And fun fact, actually, when they were starting, it was actually going to be a decentralized exchange. The legal company name is actually Secure Asset Exchange. Unfortunately, the technology couldn't support on-chain order books at the time, so they pivoted. We introduced a guy named Ari Juels to the team, and the rest is sort of history. They became an oracle because it was a key piece of infrastructure. I say that because we actually invested in the equity of the company, but I have to represent my limited partner's interests in making sure we get a return on risked capital. And the return on that risk capital wasn't going to be in the form of an equity. So we baked in an early token warrant, which basically gave us the option to purchase at a certain point in time Chainlink tokens at a very, very discount
That's
level.
interesting. So it was like an add-on to the equity deal. Huh. Do you remember your first moment?
So there's this really strange oscillating effect that takes place in the industry where people want equity and then they want tokens and then they want equity and they want tokens. And then there's this period in the middle where people want token warrants with equity, and it has bounced back and forth in this now for at least 2 cycles. Now we're finding ourselves back on the kind of the equity swing of things. So I think it's really more around market trending more so than anything else. I mean, everyone likes optionality, like when you look at deals, and also it depends on the mandate of your fund, right? Do you have the ability to participate in tokens? Do you have the ability to participate in equity? And what is the term and length of your fund? If your fund is 5 years, equity is really tough. If your fund is 10 years, then you can have an equity position. So that really dictates kind of how you approach that.
Kavita, if you could answer the same question. I'm really curious because you've done so many token deals now, and your fund is dedicated now to this form of investing. So what was your very first moment of buying an NFT at all?
Yeah, I came from a traditional investment background, World Bank, IFC, Eric Schmidt Family Office. So when I started doing this crypto VC hedge fund, first at Consensus and at the Delta, where we invest both equity and token, we really look at what does the founder want, and based on the founder, does the token really make sense? And sometimes you do realize that the type of network effect they are looking to get, even if the token does not really fit in a standard mold, there is no way they can get there with just doing an equity deal. So for something like analytical platform, you don't need to have a token to have a friction, like one more layer of volatile asset to buy and sell to get that data or something. But at the same thing, I truly believe in wallets. Like I'm still trying to figure out if wallets start having tokens, how they're going to do it. But when you have layer 1, layer 2 solutions, or anything where token actually not only have a reason to be, but the network effect for open source projects to come on top of it should have a token, then you go for it. And I have always felt very comfortable with token deals because I've always looked at them as doing an IPO, but much earlier with different risk associated with it. So as an investor, when we are looking at token deals, I actually, and this is for a lot of founders in the room who may be thinking about how to think between equity and token. And of course, there are different investors, as Andrew mentioned. Some really push for tokens, some really push for equity. We look like, okay, so if we have 4-year, 5-year mandate, and there is a bullish cycle and a bearish cycle, there is another thing which a lot of people outside the industry don't really talk about, which is true investors usually have vesting periods of 2 years, 3 years, 4 years on those tokens. So it's not a pump dump, which we saw in 16 and 17 anymore. So I'm also factoring that in and making my decision and saying, okay, so if I'm going to go 3 years from the token launch, but I'm putting my pre-seed money today, which is another year and a half before the launch, at what point am I getting the return, but also showing my strategic support to the project? And so long story short, I feel like both models are fine based on if the founder can justify, can have a team or the investor support to really go and work what they need to do with token. You have to market make it, you have to do a proper launches, you have to get the right retailers on board. I think there's a lot of extra hard work for the tokenomics, which like Republic is one of the leaders to do that, which not every founders get to do. And I think that should be the reason to do it.
It's also very rare that value accrual happens in both places. It's usually one or the other. So and sometimes you'll see people raise equity and then they'll raise for tokens or vice versa, and that's usually not a great sign. Especially token then equity. So it's usually value accruals in one of those places. We primarily touch tokens generally, mainly because Republic's one of the largest infrastructure providers just globally, and in our SAFs, generally, if there is some type of staking feature associated with it, we'll build that in to our lockup so that we're producing yield out of the gate. That does two things. One, we stabilize the network for them, which is a really big problem that most people don't even take into consideration until later. And then second is it allows us to also then start earning from that asset, well before our lockup period ends. So that makes us, we try to sit as one of the better actors in the space with that framework. In equity, you can't do that. You have to ride that out.
I think your question to him should be, he said one of the best, one of the good actors in the space. Who are the bad actors?
Who are the bad actors? Oh, good Lord. Open up CoinDesk and start reading pages.
There was a panel, similar panel at Bitcoin MIT, and the question came up, do you tell your companies when you're selling the tokens and you're on the board? And it's like, is that even a question?
So, it's a very interesting thing. We have thought about it, and all our founders have the wallet addresses on which they send the token. They can literally go online and map that out, and founders do that often. So I don't think it's a secret. That's the pure magic of blockchain.
Yeah, I mean, we have two different strategies. Our fund has a strategy, and then there's a Chinese wall, and then there's an advisory arm of Republic. And they have two different approaches. The advisory arm's actually never sold tokens. We're extremely long in the space and makes us one of the better partners in that framework. We'll sell staking rewards, but principal, those always stay. As far as our fund goes, and we're super open about this, we take liquidity as soon as we can because that's our responsibility to our LPs. Now we'll do that in a way that's appropriate. We'll work with market makers, work with the founders and the team, and maybe even sell things, offline if we can do that and not affect the actual token price. But listen, we're fiduciaries at the end of the day, so we have a responsibility to our capital.
So right behind your head, there's another panelist who hasn't spoken yet. So Kevin, you're very much like we are, early stage kind of life, and then now all of a sudden, well, for a couple years now, you've been at a multi-trillion-dollar asset manager. I mean, I don't know what the really big checks look like, but what's a perfect deal look like for you now?
I mean, a perfect deal for my fund and my group is seed stage. I would say average check size anywhere from maybe $500,000 to $1 million. No board seat whatsoever. We have no interest in controlling what should be a distributed network that is community owned. And so even though we may look like the large asset manager in the room, I do not want to have a controlling stake in something that should be truly decentralized. I've spent a lot of time investing and analyzing DeFi because I spent a number of years building models and using data to mitigate default risk. So I spend a lot of my time personally investing in DeFi and lending protocols and really making sure that I'm able to underwrite every stop that a dollar makes or every stop that a cryptocurrency makes along the way. As you're reading the docs, is that lending protocol rehypothecating funds? When you asked the question earlier, how do you value a token? Sometimes you can value it to zero very quickly because there's an Achilles heel in their docs that no one's seeing, because people just assume that the smart contract is going to replace a legal functionality where there's really no legal precedent set yet. And so for us, it's who are the lenders out there that are building true lending protocols that facilitate ethical lending using real on-chain and off-chain data, and they don't rehypothecate or leverage your funds somewhere else. That enables me to get into a real revenue generating use case and really apply fundamental analysis to token analysis to then target the C corp, which owns the equity, and then the token, which owns part of the revenue flow that's coming from user participation. So I spend a lot of my time really looking for an Achilles heel, which is usually hidden in a white paper somewhere. And I can very, very quickly dictate whether or not what they're doing is legal or illegal. I would also state that, or ethical and unethical. I think for the crowd, it's also very important. You saw SAFs as the flavor of like early 2021 and before. Now you're seeing equity and token warrants. That has a lot less to do with what people want and more to do with what people fear, right? They don't know how regulation is going to shake out. And so if you just buy a token, do you have any exposure to the ownership of the IP that was built within that company or the C corp that sits next to it? The answer is probably no, unless you have really good outside counsel. And so that's where I spend a lot of my time in understanding, what is the real revenue generating opportunity for the token? Is there an incentive for me as the investor, for the founders, and for the community? And is it aligned? And if that's yes, yes, and yes, then I look for, okay, is this lending protocol built by intelligent people? Yes. Do these people understand that a smart contract does not have a lending license in the United States, right? And so there's a lot that we can draw on from historical experience to avoid what I think are implosions, too much leverage, rehypothecation of funds, algorithmic stablecoins that are pegged to volatility. It's not rocket science, but I do think you have to dig deep in every white paper that you do invest in. And what I've seen a little bit too much of over the past year, and keep in mind, I've done nearly 20 deals for Franklin, which is kind of a lot in 330 days. Our cadence that's faster cadence. But I've seen a lot of like, hey, if you got a deck, we have a check, because a lot of money has been raised. And we're trying to break that mold a little bit. Like, I think there's room for very large asset managers in this space. My legal team was not 100% comfortable when I first pitched it, but now they are. And so I think there's just, we can be in a crypto winter right now, but I am more excited about this space than I've ever been.
That actually, something you mentioned there brings up a really interesting follow-on question, because we have a bunch of companies in the room, I happen to know, and they're early stage, and they're coming up on a decision on whether to raise capital with an equity raise or with a token raise or with a hybrid of the two. And I know, Kavita, you are in both OpenSea and SoRare, which to me look like very similar companies, but OpenSea did no token, pure equity, $13 billion valuation. And SoRare did this monster token drop that was huge. They raised a ton of money, like hundreds of millions of dollars in the token drop. Is that right? It was SoRare, right? I'm pretty sure. No? No? No. Was that pure equity?
Yeah.
Who's the other OpenSea competitor?
Talking about super rare.
Oh, you're right. Super rare. Okay.
Super rare.
So you were into. But anyway, so let's take the case study then. Super rare versus OpenSea, virtually identical. One doing massive token raise, the other doing equity. What's the logic?
I think, again, so Super Rare basically goes for really high-end art NFT collections, and So Rare is completely into gaming, especially European football or soccer in US. And I think for both the model, it works, right? I don't have insight into Super Rare, but as an outside investor, it makes sense that if you're doing high-end pieces of art, you are going to do tokens because in the future, fractionalization of NFTs and lending and borrowing and the whole NFT fi opens up with that. But for SoRare, they work with some of the biggest football clubs. And so having a token would actually create a lot of problem for them for the institutional adoption. So even today, even outside NFT, every time, look at Encourage, they didn't do token for the same reason because if they're going to have custody for Goldman Sachs or JP Morgan, having tokens going to be a problem for institution. I think for your question, the perfect example is QuantStamp, and I think I can say it very respectfully. They did a token. And then they realized that with that token, they were having a lot of problems with new funds coming, new projects coming and trying to do smart contract security with them because they don't have money to buy the variation of tokens, especially at the high time, and get the contracts done. So they had to include USD as a payment. And then over time, with the institutional adoption, they realized they just have to go the equity way, and they have to let go of the token. And now they are just doing equity round raising.
Yeah, they just closed it.
Yeah, I would also add in there that you bring up a really good point in that dialogue. I would just add that there are too many projects out there that are looking for a use case for the token, and the only use case they can find is price speculation. And that's going to cause a problem for them, for regulators. And so what was just listed was a really good example of where token had actual utility, right? And facilitated participation in the project. And I think so many entrepreneurs right now are just forcing themselves to, they find a solution, but that solution may not need a token, right? You're still able to innovate outside of the token landscape. I would be very cautious on making sure that your token has an authentic use case besides holding for price speculation, utility, governance, right? And creating efficiency within the community that wouldn't exist without the token. And so if that doesn't exist, you're probably not going to pass a Howey test.
We saw, it's the number one question we ask is like, do you need a token? Or we'll ask, my favorite way to do it is to lead them down a question path of, if the token stopped working for a moment, would your product still work? And if they tell you, oh yeah, no, the product's still fine. No, it's fine. Then the question is, well, then why do you need a token? You clearly don't. You can just use a database or some other feature set. So we saw 178 projects last month. Maybe 10 needed a token. We chose to work with about 3 of them. So the vast majority of projects that you see do not need a token.
But I think there's another layer to it. There's like now you have new systems like DAOs. Right? And investing in DAOs using governance token in DAO is something which I absolutely don't understand. As an investor, I don't think as an investor, at least for me, I don't think I have all the answers of new ways which people expect us to invest. So I have been openly asking everywhere, somebody has to teach me how to invest in DAO because I'm not buying a governance token for DAO.
Yeah, this is.
Well, most people are coming at you with an SPV structure now, and they're calling that a DAO. Right. So they're saying, hey, will you invest in my DAO? But it's really just an LP and SPV structure, which tells us that there's no legal on-ramp yet that's been clarified.
It's very weird and shady.
Yeah, then they're going to convert to a DAO. That's a huge pass.
Interesting. So John is telling me we only have a few minutes for a couple more questions. We have what? 1 more minute? We'll take over the next section.
It says 6.
Okay. It says 6, yeah. Dang it. All right. We have time for one more question. If anyone has a question they've been dying to ask, you got to stand up and yell it out right now, otherwise we're going to run out of time. So I'm going to ask, so global work, one of the beautiful things about this NFT economy is that it unleashes global work. I grew up in Iran, actually, before the revolution, and it's funny, we had an intern a couple of years ago at Vestigo, and her family is still in Iran, and she was here at Northeastern. She was telling me that her family went to the bank. The bank account, the banks literally said, your money is gone. And like, what are you talking about? No, it just vanished. The government took it. We don't have it anymore. So now in Iran, everybody has all their money in Bitcoin. It's illegal, but everybody has all their money in Bitcoin. And people spend up to a third of their annual income on their phone and their data plan because that's where all their money is. And then all the transactions at the bazaar that used to be done in reals are now done in crypto. So my guess is this global workforce that kind of when we went to open courseware and Harvard and MIT and all the schools made all their educational material freely available to the entire world, and that was about 15 years ago. Those are now educated people all over the world that are suddenly employable, and now the blockchain comes along and creates a framework where they can be hired and paid in Bitcoin or whatever else. So how do you see that? Is that a big part of what's going on in the portfolio? Is it a factor today, or is that a few years out?
Yeah, it continues to be a really interesting area, especially as, I think COVID and decentralized web is so inherently distributed compared to traditional companies, right? Many companies founded out of MIT, set something up down the street. In this space, people, are online, they're basically building these companies decentralized, especially in the case of DAOs, which actually means payments are being done for a lot of these DAOs across many national borders. And rather than go through, a lot of traditional systems, people basically just pick up stable coins and send them to wherever they go. And I think that continues to be one of the big opportunities. And I'm not surprised you're seeing it in local commerce in places like Iran and others. We just did an investment in Istanbul where, hyperinflating country, where basically everybody wants to just get into DeFi rails, and providing even simple infrastructure to do that is now engendering a lot of trust and even adoption from previously not crypto native people, where they're starting to see, okay, this is actually a viable alternative. And you can even see my shirt, Bankless. I do think there's going to be a group of people who are now choosing to opt out of keeping money into a traditional financial system, and self-custodying. And there's a lot of interesting questions around self-custody and what it means to have denationalized money. So it's quite the rabbit hole.
I think we last time when we were sitting in Dubai, I was making a joke. I said my biggest bottleneck of the fund is Bank of America, like a fund account, because I can do a $5 million USDC any moment, just have the authentication out, anything, but I have to keep on going to my bank to keep verifying my identity in person, physically, every time I do a big transaction. So in fact, as a blockchain fund, we ask our companies that just take money in USDC, and even for the workforce. Today, between our 34 portfolio companies and our own team, I think we are touching 82 countries where the workforce comes from. And the power of stablecoin and the self-custody and them able to convert it into their local currency, or also being global citizen based on that without no country and no government or bank telling you, is a power of blockchain.
We have offices, a bunch in the US, but then we have offices in London, Dubai, Singapore, 2 offices in Seoul, Korea. And paying people internationally, even for us who are crypto native, that aren't in one of the jurisdictions of which we have an office, is very difficult, extremely difficult. And we experienced something this year that we did not anticipate, at least not to the extent, where we had an office of 52 people in Moscow, with a lot of our developers, marketing people. And when the conflict in Ukraine was arising, we pre-funded our accounts there for 6 months of runway, just in case something would happen. And as things started to stabilize quickly and the ruble fell, our 6 months became like a month of runway there. And you had to hold the assets in rubles there. It wasn't an option to do anything otherwise. So, and then as it continued to stabilize, we actually evacuated all 52 people out of Moscow. So, yeah, which was the most stressful period of my life
Ross
ever.
Perot thing to do. Would you get a helicopter or something? Airlift them out?
No. It was just a lot of commercial flights. But it was very, very, very difficult. We were actually, one of my team members was on like the last commercial flight out of there before it really locked it down. But we got everyone, we relocated everyone to like a mixture of like Turkey and Georgia and now Dubai. Now we're moving, our Dubai office is going to now house everybody. But just a lot of this, we simply couldn't pay anybody.
I think the underlying power here is even when they got on the plane and start in a new country, they had money in their phones to start a new life.
Oh, I had a group of team members meet us in the Dominican because we were doing a quick offsite there, and they arrived. They had their bank accounts were shut down, their passports were basically canceled, and they only had clothes from Russia, and they had no money.
All right, we need to be good citizens and vacate the stage now. The next panel is here. But if anyone needs to get in touch with anyone that was on this panel, just go through John Werner. He has all the contact information. So really fantastic having you here, and I know your time is extremely valuable. Much appreciated.
Thank you.
Here,